In this first lesson of our Financial Management Theory series for Degree and MBA students, we will explore one of the most fundamental principles in finance, the time value of money. This theory explains that the value of money changes over time because money today has the potential to earn returns in the future. In simple terms, a pound in your hand now is worth more than a pound you will receive in the future because you can invest it and earn interest or returns on it. The ability of money to grow through investment or savings is what gives rise to the concept of the time value of money. This principle is the foundation of almost all financial decision-making. Whether a business is evaluating an investment opportunity, comparing loan options, valuing a bond, or assessing the worth of future cash flows, it must consider how the value of money changes with time. Financial managers use two key measures to do this: future value and present value. Future value tells us how much an amount invested today will be worth at a specific point in the future, while present value tells us what a future amount is worth in today's terms. This means that if you invest a certain amount today and allow it to grow over several years at a given rate of return, you can calculate what it will be worth in the future. For example, if you invest £1,000 at an annual interest rate of 5% for 2 years, the future value would be £1,000 multiplied by 1.05 squared, which equals £1,102.50. Conversely, present value helps us determine how much a future amount is worth in today's terms. The formula for present value can be expressed as present value equals future value divided by 1 plus the discount rate, raised to the power of the number of time periods. This calculation discounts future cash flows back to the present, recognizing that money to be received later is less valuable than money received today. For instance, if a company expects to receive £120,000 in 2 years and the discount rate is 8%, the present value would be £120,000 divided by 1.08 squared. This equals approximately £102,880. Since the project only requires an investment of £100,000 today, it would be considered financially worthwhile because its present value exceeds the initial outlay. This process of discounting future cash flows is at the heart of investment appraisal methods such as net present value, often called NPV, and the internal rate of return, known as IRR. These methods allow managers to assess whether a project or investment will generate sufficient returns over time to justify the initial cost. When banks offer savings accounts or loans, the interest rates they quote are directly linked to this concept. For example, a saver who deposits £1,000 at a 5% interest rate will earn £50 in the first year. If they leave both the principal and the interest in the account, the next year's interest will be calculated on £1,050, not just the original £1,000. This compounding effect demonstrates how money grows faster over longer periods. For businesses, the time value of money influences a wide range of decisions. When deciding whether to lease or buy machinery, issue bonds, or reinvest profits, managers use the principle to assess the long-term financial impact. A firm may choose to retain earnings and reinvest them instead of paying dividends immediately because the expected future return from reinvestment could be higher than the value of the dividend payout today. Understanding this theory enables finance professionals to make more accurate and rational decisions. It highlights the importance of timing, interest rates, inflation, and opportunity cost when managing resources. By quantifying the relationship between money and time, financial managers can better evaluate investments, loans, and strategic choices. The time value of money remains one of the most important foundations in financial management because it connects short-term decisions to long-term value creation. Thank you for listening to Mr. G, your business lecturer. Please like, subscribe, and comment.